And welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. We speak to your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. And if you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think someone might find this of interest, why don't you go ahead and share it with them as well? So we are starting the Sukkot holiday, otherwise known as the Feast of Tabernacles. I don't know how you spell that, but it's Tabernacles coming up soon. What's really interesting is that, believe it or not, you can make an association with an investing concept. One of the things that we do to celebrate the holiday is we take the four species. We take a palm branch, a myrtle, some myrtles, some willows, and a citron, which is like a lemon. It's called an etrog. And we put them together and we make a blessing and we shake it. And if we are lacking one of those four species, it's null and void. It's as if nothing happened, right? You need to put all four things together. And all four species are completely different from each other. But they combine to make one unit. It's a unification process. And it is that specific call for unity, first of all, which is muchly needed right now throughout the whole world, I must say. Well, the world sort of doesn't know where it is. We could definitely use some unity. But I would like to segue this into an investing concept called asset allocation. What is asset allocation? Well, according to Investopedia, it's how investors divide their portfolios among different assets, which might include equities, fixed income, cash and its equivalents. Now people put in private equity, private credit, alternative investments, all kinds of different things, real estate. Investors ordinarily aim to balance risk and reward based on financial goals, risk tolerance, and investment horizon. The reason that it's important is there's no formula for the right asset allocation for everyone, but the consensus among most financial professionals is that asset allocation is one of the most important decisions that investors make. Selecting individual securities within an asset class is done only after you decide how you divide your investments among stocks, bonds, and cash equivalents. Like I said, this will largely determine your investment results. That's the important thing, getting down to the nitty gritty. How you're actually going to invest, that's secondary. Investors use different asset allocations for different distinct goals. Someone saving to buy a new car or a new house the next year or so might invest those savings in a conservative mix of cash, CDs, short-term bonds. However, individuals saving for retirement, which could be decades away, typically invest most of their retirement accounts in stocks, or they link themselves to the stock market, because they have time. Time is an ally. It's on their side, and they can ride out the short-term market volatility. Another concept is called age-based asset allocation. This is what I learned when I got into the business. Financial advisors generally recommend holding stocks for 5 years or longer. Cash and money market accounts are appropriate for goals less than a year away. Bonds fall somewhere in between. Financial advisors once recommended, this is what I learned, subtracting an investor's age from 100 to determine what percentage should it be invested in stocks. A 40-year-old would therefore be 60% invested in stocks. Variations of this rule recommend subtracting age from 110 or 120, given that average life expectancy continues to grow. Portfolios should generally move to a more conservative asset allocation to help lower risk as individuals approach retirement. Maybe it should, maybe it shouldn't. Is a theme of mine, right? Is there's nothing off the shelf. Everything has to be individually tailored. There could be a myriad of reasons why you should not, or why you do not need to make your account more conservative as you age. Maybe you have plenty of assets and it's for the next generation, or it's for you're leaving everything a combination for the next generation and for philanthropy, right? Where you'd be happy to leave as much money as possible, so you can continue to be growth oriented. You don't need any of the money that you've got. You've got enough money in the bank. You've got from pensions and Social Security or whatever it is. You've got more than enough. You don't, real estate income coming in. You don't need to touch this stuff. There's no reason necessarily for it to become much more conservative as you age. Just let it rip. On the other hand, if this is all you have, a couple $100,000, and between that and Social Security, that's how you're going to eat. Well, then you do have to get more conservative. It really has to be specifically tailored. That's why I don't like articles like the one I'm reading from, because it's just not true. It should, right? Portfolios should generally move to a more conservative asset allocation to help lower risk as individuals approach retirement is not necessarily true. Right? It just shouldn't necessarily, generally is a misnomer, not a good word to put in that sentence. I know you might think I'm nitpicking, but that's just the way that it is. Okay. What's a good asset allocation, they say? What works for one person might not work for another. Ding, 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 ding. There is no such thing as a perfect asset allocation model. A good asset allocation varies by individual and can depend on various factors, including age, financial targets, and appetite for risk. Historically, an asset allocation of 60% stocks and 40% bonds was considered optimal. However, some professionals said this idea needs to be revised, particularly given the poor performance of bond in recent years, and say other asset classes should be introduced to portfolios. Yeah, maybe yes and maybe no. Again, what's really, really important, and I don't want to, just keep coming back to this and bore you, right? But it's really important that before you set your specific asset allocation model, you figure out what are your goals, what are your needs, and what is your financial profile, right? What do you have? Where do you want to be? That will help determine, more than anything else, what your specific asset allocation model should be. And yours and your neighbors, or yours and your coworkers who you're speaking to, when you're making coffee or over the water cooler, and you're talking about individual stocks or this or that, or my advisor or this advisor, your situation is 99% of the time is going to be completely different than your neighbors. And as such, you need to have a discussion. You might end up with the same asset allocation model at the end of the day because maybe it's similar enough, but you need to really analyze it or sit down and speak it out with somebody who has some experience and figure out what is right for you, right? Where do you want to be? What are your goals? What's your financial situation? Do you have inheritances maybe on the way? Is what you have now all you're going to ever have? Are you already retired or you're pre-retirement? What do you want to do when you retire? These are all really, really important issues. And to just pull off the shelf, 60-40 seems good. That's not a particularly great solution. Okay? You've been tuning into the Aaron Katsman Show, where we speak to you about your life, money, and your investments. If you like this content, please hit the like button below. And if you've not yet done so, shame on you. But if you've not yet done so, please subscribe to both the podcast and to the YouTube channel. And if you think somebody might have found this of any interest, go ahead and share it with them as well. Thanks so much for tuning in, and we'll speak to you soon.